Well, guys, I have to say something very interesting. Let me remove this video capture device. Oh, there you go. So we have the full thing. Good morning, everybody. Welcome aboard Investment Club, guys. My favorite club. This is Carlos, CEO of GAR Capital. I apologize for laughing just for the simple fact that I have been speaking for 45 minutes and I forgot to press the record button. So I went over the whole thing, basically what I was talking about for the year, and I didn't press record. I can't believe it. I'm using my OBS system because it's a little more crisp than the GoToMeeting personally. So I apologize. Let me catch myself. I'm just laughing because I can't believe I forgot to press record. I pressed streaming. Dumb. Very dumb. It's Sunday. It's January 22nd, 2023. Hope everyone's having a nice morning. A couple of things that we don't have information yet. We don't have all the earnings yet, mind you. We don't have the Fed decision from February 1st as of yet. So let's start with what I started with before. If you guys have been reading the newsletter and talking on the blog, or been reading the blog, like and in the morning note and everything like that, you guys may remember that I talked about in December that we'll get a 25 basis point rate hike and pause. That's kind of what is expected. Now, it seems that the Wall Street Journal is agreeing with me. How about this? The Fed sets course for milder interest rate rise in February. Officials could start weighing in on when to pause rate this spring. Wow, pretty much nailed it. And the reason, I guess, if we are correct, the reason I nailed it is because you have to watch what people say. I mean, people do, not what people say. There's a big difference. It's kind of like poker, right? Poker face, everything, trading is like poker. You got to see, kind of see how the market is, see where the opportunities are and such, bluffing. And I think the Fed is bluffing, my opinion. That's my opinion anyways. Let me see here. Just want to make sure that I didn't close anything. Good. All right. Now, I usually do a webcam on the bottom, but it kind of blocks out the Bloomberg. And I just want to make sure that you see the whole chart. That's very, very important. So we just talked about the Federal Reserve. Let's go ahead and start with that. And then we're going to start with the Federal Reserve on our first chapter, or first part of this video. We're going to talk about the possible headwinds. What are some of the things that can make this market go down? We're going to talk about the investment thesis. We're going to talk about the targets. We're going to talk about the debt ceiling as part of the headwinds, obviously. And we're going to talk about what stocks or what are the things that I'm looking for in terms of the themes that we're looking the themes that we have in place that are going to be benefited, what stocks are going to benefit from those themes. God, I don't know why I said that even worse than it did. Okay, so with that being said, we know, at least according to the Wall Street Journal, the Federal Reserve is going to go ahead and pause. We don't know how much they're going to raise in February. I think it's 25 and pause. If we do, what happens? Well, if you take a look at the S&P 500, the most popular trend line in the world right now to the downside, we also are now building a wedge. As the wedge gets tighter, we know technical analysis, we can go higher or lower depending on some volatile move. I expect us to go higher. We'll probably reject 41.69 or so when we have the FOMC. My target personally by end of the year, and I will type an outline of everything here for you guys if you guys don't like watching videos, which I get. I'm not going to make this death by PowerPoint or death of speaking. Again, everyone's been to college for the most part and it's boring, right? Lectures. We don't want that. So again, I'm going to try to make it as easy and painless as possible. The target that I have for the end of the year is the August highs. August 16th, 43.25, 4,300. That's my target for the end of the year. I'm kind of fighting myself to say that we can possibly get to 4,400 with some really good news. And that's very, very possible. Really, the zone I'm looking for is 42.44 as support, and right here around 43.26 to 4,400 being the bull case. I don't think we get to all-time highs this year. I don't think that's going to happen. We need some really, really good news. We need pretty much perfection to get there. I don't think that's going to be the case. I see improvement, but not perfection. Why do I say improvement? Here is the thesis that I have. And I wrote it down, so I have to check. Lower rates, lower dollar, lower inflation. That's the three-headed prong thesis of this year. If you remember back in 2020, I had Bitcoin betting blunts. Betting now, sports betting is getting a little more out out there. More states have it now. So again, it is building. Cannabis, I mean, well, you know, it depends. There's a lot of cannabis out there from what I've read. We still don't have legalization here. I think when it does get fully legalized, which I expect to do, then we'll see that, you know, marijuana stocks are going to actually pick up. And then the third is Bitcoin betting bloods Bitcoin. So let's go ahead and we'll talk about, we'll pause Bitcoin there. Let's bookmark that. We're going to get over that in a second because I know that everyone's watching Bitcoin. And I remember what I said. If we start breaking above 20,000, that's where interest starts getting a little higher. People start getting very, very interested in Bitcoin again. Trying to catch the bottom, hodl, diamond hands, all that jazz. Mine's in my stupid Trezor wallet. Leave it in the safe. I don't even want to look at it anymore. It's pointless. Not like I'm going to do anything. Just leave it alone in that sense. We can wait for that. Again, that's what investments are for. Just wait it out. It's time. It's a race against time per se. Okay, S&P 500. Now let's start going over what can possibly go wrong. What can happen that can get us down? I don't think we will, but again, it's important to see. If inflation is still sticky, again, inflation, rents are still high, housing is still high, goods are start kicking up in terms of cost, which I don't think that will. But services remain high due to labor costs. If employment is still, unemployment is still relatively low, maybe starts getting lower, you know, start testing 3.2% unemployment, that's not going to be the best thing for the market because wages get too strong. And again, that's still inflationary. We don't want that. So you got to be careful. We want unemployment to tick up a little bit, not too much, just a tad. I think 4% would probably be that sweet spot. That's 0.5% where we are today, 3.5% unemployment. We do have some layoffs in the tech sector. I've seen that's been pretty concentrated in the tech sector. Google, Twitter, which went private. Apple's not laying off anybody from what I've read. I think they're pausing some of the augmented reality stuff. I think they're still working on their car and all that jazz. Google is, laid off people. Meta laid off people. Microsoft laid off people. Amazon laid off people. I don't know if Tesla has. I have to read that and make sure that they have it. But again, it seems to be very, very tech-centric. Why do I say tech-centric? And why is it tech-centric? Because these tech companies spend. They spent when money was cheaper to grow operations for innovation. And that's really, and guys, remember it. Inflation obviously is a problem. We know that. Inflation has peaked in June. We know that. We've been tracking that with you guys. The problem is that you need inflation because the world is inherently deflationary due to innovation and technology. When you have AI, you know, writing your papers like ChatGPT, you know, when you have AI starting doing different things, menial tasks, it takes away from those remedial jobs that pay low wages. Don't be surprised in the future. You start getting a little robot delivering your plate of food. Waitressing may go away with AI technology. Customer service jobs may go away with AI technology. Truck drivers, the cost of moving goods back and forth could be AI autonomous driving. Again, innovation is the most powerful deflationary force on the planet. When you make things easier to make, easier to create, it lowers costs. Again, if you don't have to pay a waitress staff wages, they don't have bathroom breaks, they don't have to go, they don't call in sick. It's just a robot with AI taking your order. We've seen it in the McDonald's where you have the little kiosk where you just press a button and you order it. They don't have to pay a cashier. Again, that lowers wages. That lowers inflation. Again, that is deflationary. Always remember that, guys. That technology and innovation is always deflationary. We have to have inflation. We have to. If not, prices fall. And prices fall to the point that there will be no one employed. And again, you can have 99-cent gas, but that's meaningless if you don't have a job. If you don't have a job, what's the point? You can't buy anything. There's no work. The reason that people are spending now and we still have some sticky inflation, whether it's gasoline prices rising a little bit from the lows that we were, I think, sub $2.99 in gas. Now we're around $3.18, $3.20, is because demand is still relatively strong because people are working. And I think people need to understand the difference between demand inflation and monetary policy inflation. Monetary policy inflation is created when you start printing dollars to pay for wars and extra stuff not needed, for example, or not, I don't want to say not needed. I'm not a politician, but you know, pet projects, infrastructure, again, that's spending money. That's inflationary. You know, when you're paying, you know, trillions of dollars or billions of dollars to do foreign affairs, military exercises, whatever, that's inflationary. We know that. Again, when you have more spending, that's inflationary. But again, we know that the world, in terms of innovation and technology, that's deflationary, guys. The world's going to be a lot different in 30 years than what you know now. If you guys just saw, I mean, now we're starting to see AI really answering your questions, a better search engine where you can just ask it questions, it will break it down for you. Chat AI, Chat GPT now, again, look at the universities. That's going to make term papers easier to write. We can just copy and paste. We've had this when I was in college with Wikipedia, right? You could just copy and paste that and pass that stupid survey course, fine. But again, the ease of goods and services moved, transports, when things get easier, again, when you have autonomous driving and you have truck drivers that are, there's no more truck drivers because you just have autonomous trucking coming in. This is the problem now. We don't have it yet. So again, these truck drivers, would you want to be a truck driver today knowing that maybe in 20 years your job may not even be available? Probably not. So again, it's harder and harder to get truckers to move the goods and items that we purchase to the shelves. And again, that's sticky inflation. Until innovation really takes off, inflation will still be sticky. But deflation, at least we're seeing an acceleration in deflation in the PPI number we just had last week. Again, we saw a negative growth in terms of PPI. We've seen PMIs, the services PMI being in contraction. Anyone who says inflation is still running rampant is not paying attention because inflation has peaked. The problem is, guys, deflation is not good either. Deflation is very similar to the 1990s of Japan, the lost decade, where it gets to the point that things are so cheap, there's no demand. Again, guys, it is easier to create supply than it is to create demand. So again, inflation has peaked in June. I think we can all agree, and it's sliding and sliding. The problem is sticky inflation. If we get sticky inflation with rising unemployment and a little more worsening events geopolitically in terms of the Ukraine-Russia conflict, that's where we could start taking a look at 3683, 3500 S&P 500, 3500 being our low, where we got right here. That was the October FOMC, I believe, or PMI. No, the October CPI number. And again, we bounced from around 3,500 to around 3988. So about a 500-point move. So again, if we get escalation, the words of nuclear weapons are coming out, all bets are off, okay? I think then we're not worried about the stock market anymore. We're worried about humanity. We'll take that to the side. What could get us down here? If earnings are really, really bad, if earnings are absolutely disastrous, we just got earnings from Netflix. The EPS was a miss, but their subscriptions were up, which is really, really a good sign for Disney, Meta, Google, and of course Netflix. These are all part of the same sector. Communication services, we could see it here. We'll go to year to date. And you could see why these names are higher. Again, love Google, as you know. Meta up 15%. Netflix up 16%. What a big move. This is just year to date. This is from Jan 1 to Jan 22. And again, the reason that these are moving higher is because we've had the increase in subscriptions. It's subscribers for Netflix. How about NVIDIA? Up 22% since the start of the year. Microsoft pretty much flat. But look at the names that are not doing that great. We're getting a rotation. I talked about value names like Coca-Cola, Pepsi, Costco. Again, they're starting to get too long in the tooth. One thing is a growth company getting a high valuation. That's expected because their growth prospects are so high. We don't know what they can bring to the table. I know what Coca-Cola brings to the table. There's not much there. I mean, they may have at best a 2% growth model, maybe 1%. Again, guys, they're not making new sodas. They're not acquiring anything new. I mean, Coca-Cola and Pepsi, they're stable. They pay a dividend. You're not going to get much. That's just what it is. Walmart down 0.88%. Target up 8% year to date since we started. Remember, I closed that target at break even. I think you guys took that target trade. That was nice. Merck we took too. Merck is down 1% this year. We're starting to see a little rotation out of healthcare, kind of the safe names. Healthcare did great this year. Consumer 2022. Defensives did well in 2022. How about aerospace, war stuff, right? There, except Boeing. Boeing, watch that. Energy holding up fine, but energy's been kind of choppy. So what has been doing well? The growth names. Again, a little bit of rotation. And why are we getting this rotation, guys? It's simple. Interest rates are coming down. It just is. It's just what it is. TNX, 10-year yields. The expectation on a 10-year yield for me is to get us around 2.575%, which again increases more mortgage activity. I like banks here. Kind of counterproductive, right? Well, rates go higher, banks do better. Not necessarily. But if we can get some deal making, maybe some refinancing of homes bought in 2022, again, that's a little inflationary too, we know. But again, if rates can come down, I expect around 2.575. That's the low that we've had in August. August low, which lines up with the August high of the S&P 500. Very, very similar. So that's kind of what I'm looking for in that sense. Lower dollar, lower inflation, lower rates. Lower rates are important because it's going to help the tech companies do better. Don't expect these high beta names to get to all-time highs. Football's not going to get to all-time highs this year. Coinbase is not going to get to all-time highs this year. Space, Nvidia, Shopify, Tesla, they are not hitting all-time highs in 2023. So let's not even go there. It's not going to happen. But again, are they going to bounce? With a looser monetary policy, a better, lower rate environment? Absolutely, I think they will. We have seen it recently. Again, if interest rates go lower, it makes it cheaper to borrow. These growth names can do better. Now, again, we need to see what the Fed does on February 1. We need to see these earnings as they come along. I was hesitant to actually do this video ahead of earnings because we haven't had much. But again, I don't want to kick the can down the line forever either. So again, here's the video that we're making now. This is my thesis, obviously, for GAR Capital. But understand that the facts can change. So again, I still think we're going to get to the August highs. But again, just be vigilant. That's all I'm trying to say. So with lower rates, lower inflation, lower dollar, let's go ahead and talk about the debt ceiling because that's something that a lot of people have been talking about. The last time we had a debt ceiling crisis was in 2013. Just so you know, that was during the Obama administration. He just got reelected. We had a Republican House, Republican Congress, obviously. And this is the S&P 500. Let's just give you the heads up. This is from Jan 2, 2013 to December 31st, 2013. Okay, look at this. We went from around 1475 to around 1848. If we want to do the math and see, let's see, S&P 500 2013 returns. Instead of me doing the math, I could just get the total here. The S&P 500 gained, that was S&P 500, no, that's not what I wanted. Historical returns, we'll go to macro trends and see if I can get the number. 2013, we gained 29.6% on the S&P 500 that year. But what gives, Carlos? We had a debt crisis that year. 2013 debt crisis. This is according to Wikipedia. Following the increase in debt ceiling to $16.394 trillion in 2011, the United States again reached the debt ceiling on December 31st, 2012. The Treasury started taking extraordinary measures. Janet Yellen's already doing that now. The fiscal cliff was resolved by the passage of the American Taxpayer Relief Act of 2012, ATRA, but no action was taken on the debt ceiling. The ATRA tax cuts, the government indicated that the debt ceiling needed to be raised by $700 billion for it to continue financing operations for the rest of the 2013 year. So again, we tried to get tax cuts passed with a Republican Congress, and that extraordinary measures were expected to be exhausted February 15th. Payments of funds could not be raised through extraordinary measures. The debt ceiling has not been raised. This will put a freeze on 7% of the nation's GDP, contraction bigger than the Great Recession. The economic damage would worsen as recipients of Social Security benefits, government contracts, and other government payments cut back on spending in response to having to freeze in their revenue. The No Budget, No Pay Act of 2013 suspended the debt ceiling from February 4th until May 19, 2013. On May 19th, the debt ceiling was formally raised to $16.669 trillion to accommodate the borrowing done during the suspension period. However, after the end of suspension, the ceiling was only raised to the actual debt at the time, and the Treasury needed to activate extraordinary measures to avoid default. With the impacts of the American Taxpayer Relief Act of 2012, tax increases on those who made more than $400,000 per year, the 2013 sequester, the $60 billion payment from Fannie Mae to Freddie Mac reached the Treasury on June 28, 2013. The extraordinary measures was predicted to last until October 17th by the Treasury. This is 2013. But financial firms suggested that it may have lasted a little longer. Jefferies Group said extraordinary measures might have lasted until the end of October, while Credit Suisse estimated mid-November. So again, kind of the same song, same dance. We know the drill. You know, they're going to fight in Congress. This is a new Congress now. Republicans do have the House now. Again, we have a White House with the Republican president, and the Senate is Democratic. So again, kind of a split Congress, which is actually pretty good for the stock market. But again, guys, you can see this move higher. I mean, we moved on 2013, even with all that jazz, 29% on the S&P 500. And I believe that in 2013, let's see, debt downgrade US. When was that debt downgrade? Let me see if I can get that date. So in 2011, we had the debt downgrade, not 2013. I thought we did. But 2011, we had the debt downgrade. It went to AA, not AAA. I think we're AAA now. But again, even with all that noise, guys, we were talking about the debt ceiling in 2013. Even though the Congress is split and we had to do some extraordinary measures, yada, 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 you can see that the S&P did pretty well. So it really didn't matter. Didn't matter on yields. Let's take a look. Here's the 10-year Treasury yield. Remember, they went from February all the way to, let me make sure the date when they paused that, until May 19th. So right here, May 19th is where it actually, we started seeing that the debt ceiling. So they did the No Budget, No Pay Act of 2013, suspended the debt ceiling from February 4th, 2013 to May 19th, 2013. And on May 19th, the ceiling was formally raised. So right when that ceiling was raised, we started getting higher yields. But the S&P 500 kind of trucked along. So again, could that be an issue for our lower rates, lower dollar, all that stuff? Yeah, that's pretty much the headwind that we may have if we start getting debt ceiling issues. My contention is that this is nothing new. They're going to work on something. They're going to figure out a package. Who knows? And it's one of those bluffing scenarios where, you know, it's a lot of talk and nothing happens. That's really it. So again, we could get bond yields to get a little lower, but that could also get us the bounce as well. We have a gap to fill at 3.143% on a 10-year basis. We have another gap here at 2.899. I expect 2.575, especially if we have recessionary issues, because then the money's going to flow into government bonds. And the money that flies into government bonds to lock in those rates and to lock in that safety is adding indirect liquidity to the stock market and borrowing costs. How do I know this? Let's take a look at high yield credit. High yield credit is now above the 200 MA on the daily, and it's starting to move. We have gaps to fill, and we have filled them. We have filled some. So again, we need to get above 76.86. High yield credit, guys, let's just make this clear. This is like the subprime blending. Again, Blink would get money from the high yield credit markets, football TV. And why is high yield credit markets important? Because this is a way to borrow money in order to finance operations without diluting your current shares by not offering more stock shares. So that dilutes you. We don't want that. We'd rather them tap the bond market out there and then have their bond payments. That's fine because they can always refinance. But once you open the lid on offering more stocks, more shares, you're diluting the stocks. Again, who has done this lately? GME has done that, right? AMC, again, it's simple math, guys. It gets to the point that the more shares you offer, the more dilution you're going to get, and you can only tap that well so long. So again, I think that it's more prudent to tap the high yield credit markets because you can always refinance those bonds if you offer bonds or borrow versus, you know, trying to put the genie back in the lamp for offering more shares. Sure, you could buy back more shares, but again, if you could buy back more shares, if that was the case, then you really don't need to borrow money anyways, unless you're borrowing money for reasons of taxes. That's pretty much the only way I could tell you. But in terms of high yield credit, again, we could see high yield credit starting to push higher, starting to break out of that trend line. That's great. How about investment grade? Johnson & Johnson's, the Microsofts of the world. I think we get to 112.36. There's a gap to fill. The key level is 115.37. Again, if we can accelerate above that, that means interest rates are falling, which is a great sign. So let's go ahead and take a look now at the thesis. Lower rates, lower dollar, lower bond yields. So let's take a look at the 2-year. The 2-year being extremely important. Really, the 2-year, the level that I'm looking for, guys, is right here. Oh, I guess right here, actually. Let me just draw another line. There we go. Bloomberg can be a little bit of a pain sometimes. We need to get to below 4%. That's really the level we're looking for. If we get below 4% on a 2-year, and again, the 2-year Treasury yield tracks a little better for the Fed funds rate than the 10-year does. But the 10-year is important because that's how we base, most times than not, the mortgage market, or we can actually see what's going on. So again, can we get to 3% here? Absolutely. It's going to take a little bit, but again, that's where I'm looking for, at least in terms of the year coming in. So I still think we're going to get to those August lows, which is right here, right around 2.5%. That's my target, at least on a 10-year basis, especially if there's more fears of a recession, if there's fears of an actual slowdown of some kind. You're gonna want to get bonds to lock in rates and get that secure guaranteed payment. So again, that indirectly adds more liquidity to the system. So it's kind of interesting. You're gonna be playing it safe in order to make things risky again. That's kind of how it works. But again, we've done a lot lately in terms of the market. We've had that big drop on the S&P 500. We know that. The question is now, do we get out of that trend line? That's really it. And really, Friday's close was really pretty solid, especially for an OPEX day. OPEX days have been pretty ugly for us, at least for the market. But let's go and take a look at the dollar now. And here's the deal with the dollar. We're right there. God, we're right there at the target. Here's the target that I'm looking for, guys. I'm going to expand this to give us some context on how much the dollar has freaking moved. This is back in January 4th of 2021. Big move from around 90 to 114. The target I'm looking for, if we can get back to the August lows. If we get to the August lows, would probably be, actually, we're better than the August lows. We're right now at the May lows. Next target here, I really expect us to get to 100 by mid-year. But the target I'm really looking for is right around 97.14. That's levels not seen since March of 2022. And again, that'll get us below that 200 big MA. So if we bring up the weekly, 97 gets us the 200 weekly MA. That's pretty much the target I'm looking for as the dollar continues to fall. And again, if we have that same correlation, 1-for-1 correlation, that gets us back to around, you said, 97 would get us to, let's call it March 28th levels of 2022. If we get back to March 28th levels, we can see right there. That's exactly, we'd be at 44.49. So it kind of all links up together. What I expect with rates, the dollar, yields, all that inflation coming down, that's what's going to get us where we need to go. Let's go to the dollar. Why is the dollar important? Again, the dollar, bring it up one more time. 101.62. It's no secret that we peaked back in September. That was the dollar peak, came back down. Look what it has affected and what has not affected. Crude oil, gasoline, not much effect. There you go. I mean, we're kind of stable in terms of gas prices. You're not at $5 a gallon anymore, which is nice, but really, really consolidating here. So what's the next move? Again, if the dollar gets weaker, we're probably going to get to $90 on oil. But again, if we get more recessionary fears, then we're going to start seeing $65 a barrel on crude oil. Take a look at gold as well. And gold, we talked about this on the note in the morning, 1673. That's the level that I was looking at. I didn't buy any, but again, I was looking at that level. That was basically the target to look for. You're at 1927 now. If the dollar gets weaker, you're going to get to 2,000 for gold, which is great. So now let's go ahead and delve into the land of Bitcoin. Very, very important. If I could bring up Bitcoin. There we go. All right, Bitcoin. Let's see it. Good old Bitcoin. Bitcoin right now, 25,000 is your key level. Why is that the key level, guys? 25,000 is that high that we've had in August. Sound familiar? It seems like we keep getting to that point. If inflation, the dollar, and yields can start getting us back to August levels, at least in the stock market, that's where we're going to go. We're above the 200-day on Bitcoin. We're above the 50 on Bitcoin. If the 50-day MA, the yellow line, can get above the 200-day MA, then we have a golden cross. And we know what a golden cross means. Golden cross is a very bullish signal. Guess what else is going there? in terms of a golden cross. The golden cross is coming up on S&P 500 futures. And the higher we go in the 50-day, we're going to cross above the 200 MA. So, what is a death cross? Yellow line below the red line, the 50 below the 200, and the dollar is continuing to go down. So again, guys, here's some of the things. These are the top 10. I've done the top 10 stocks of 2023 already. But here's some of the things I want you to look at in terms of the thesis that we explained. And this is why I think is important. Here's a couple of them. EEM is emerging markets. Now you're probably saying to yourself, emerging markets, that's ballsy, right? But hear me out. Let's go to the daily. We'll go ahead and set up some levels here. Where is the Fibonacci levels? We'll do a Fibonacci retracement. We'll go from 33.49. Don't worry, I can fix that. Did I get that? All right, pretty solid. We're now near the 50% retracement on emerging markets ETF. That's emerging markets. That's, names like Alibaba and such like that. Emerging markets, again, guys, are names that are from countries like India that are growing. So let's go ahead and go over what are some of the holdings of EEM. EEM is the emerging markets ETF. As you know, let's go and take a look at it. What do they own? They have Taiwan Semiconductor, TSMC, Tencent Holdings, Alibaba, Samsung, Reliance Industries, Meituan, I never heard of that, Infosys, Vale SA, China Construction Bank Corp, and JD. Maybe the China Construction Bank I may not be too excited for, but at least you're getting some diversification. I'd rather be bullish overseas for the simple fact that the dollar's getting weaker. So again, when the dollar's stronger, that benefits the US. When the dollar's weaker, that benefits overseas. So again, I like EEM here. Again, we're about to get another golden cross on the daily, the 50 and the 200. It's starting to set up that if we get lower rates, emerging markets are going to be the sexy ones out there, where you might get Europe and Asia may outperform this S&P 500, the United States. Take a look at the daily on euro dollar. Pretty much a great downtrend. It's pretty much a similar downtrend that we had on the S&P 500. It broke above it. Now, again, you're not above the golden, well, let me see if the golden cross has been done. Yeah, another golden cross on the euro dollar on the daily. I mean, it's setting yourself up there for the lower dollar, lower rates, lower inflation setup. So look at the euro dollar and EEM. The DAX, this is the German DAX. This is the German stock market. So, and again, we knew the whole deal, oh no heat, no oil, all that stuff that was going on. Oh my God, the world's ending with the war with Ukraine and Russia. Germany was having issues with heating and utility costs. They were spending so much money on energy. I remember all of that. It was like, oh, it's going to be a disaster. And yet, look at the stock market for Germany, doing pretty solid. And another golden cross, guys. You could see the DAX ETF. It's yellow above the red. I mean, these are technical setups that have worked long term. You have that shorter moving average breaking above the longer moving average. How about this? TLT, bonds. Again, I've been saying that for a little bit. I've been wanting to be bullish bonds. We don't have a bullish cross yet. We still need to get above this here, 109.78. But again, that is something that I'm looking for because we got some gaps to fill. And again, guys, a lower inflation, lower dollar, that's going to help bond prices go higher. TLT and TNX don't exactly go one for one in terms of inverse correlation. TLT is 20-year treasury bonds. TNX is 10-year treasuries, just to give you a heads up. Another one that I like, an ETF. Again, maybe you're not big into tech and you maybe have a big allocation to technology. And again, you could use this if you want. This is the S&P 500 equal weight ETF. This is all the stocks equally weighted. You're just betting on the market, on the America stock market to go higher, regardless of Microsoft or Apple or whoever. All of them have to do well together. We're starting to test those trend lines. And guess what? We have another golden cross. Bitcoin, we talked about nearing the golden cross. I like Bitcoin long-term, as we know. If you guys want to add a little risk, how about SMH? SMH, another golden cross setup. These are the semiconductor ETF. Maybe you don't want just single stock exposure like an NVIDIA or an AMD, which we already own. SMH has them all, Qualcomm, Broadcom, all those guys. So again, if you want to own the ETF, here's a way to do it. And again, you could see AMD. AMD doesn't have a golden cross or anything like that, no real edge. NVIDIA is getting close to a golden cross, but yet SMH is getting closer. So really it tracks in close with NVIDIA. If you own NVIDIA already, I may not want to go ahead and add SMH if you don't need to, because then it starts overlapping. So it's either one or the other, you know, SMH or NVIDIA in my personal opinion. But again, I like the semiconductors as a whole. Let's take a look at GLD. This is gold. Again, pretty much some hedging for those who want to hedge. You know, look at gold, 50 above the 200. I mean, you're getting that golden cross. Could we get to 195? Possibly. But again, we need the dollar to continue to crumble. Again, 185 seems about right. And again, it's a slow mover, and this is the expectation of it. I don't like the gold miners here. I'd rather have GLD itself, the actual commodity, rather than the miners. The miners still have operations, but gold itself, the commodity, is what I'm looking at because of the dollar correlation. Another one, here's very important, copper. Copper I've been talking about for a while. And copper is a very good signal for the market when things are starting to expand. Expansion, construction, new setup, new buildings, semiconductors run on copper, electronics. Again, if you're starting to have an expansionary view of the market, a bull market, which I expect we're about to be in a new one once we get that breakout, you have that 50-day MA crossing over the 200 MA, another golden cross. We're starting to see the setups here. And again, what's the best play to play? That would be Freeport-McMoRan. Freeport-McMoRan pays a dividend yield as well. They deal with copper the biggest. So again, that's a name I would like. I'd rather be bullish commodities here because I expect the dollar to continue to fall. Boeing, another name. And you could see we are now have a golden cross. We have a big level at 219.78. I'd wait for that level if you want to go ahead and get in on Boeing. If you have not already, I'd wait for that. But Boeing had a double bottom. Boeing has been a volatile name, as we know. But again, still has a lot more to go. But again, the golden cross is there. How about this? The 50 above the 100 and now the 200-day. Boeing has a little more legs, and it's not airline related. Again, they just sell the airplanes. It's leisure, it's military, it's cargo planes. Boeing has more than just selling airplanes to airlines. And of course, the last one for me, IWM. Again, small caps benefit from a lower dollar, lower interest rates as well. We know that they're banks and energy heavy. Energy has done pretty well. I want to see if we can get above 190. And really the target I'm looking at is around 201, which is the August high. So again, I don't expect a huge surge, you know, of where we're going. So let's go back to the S&P real quick so I can get the exact number of where we think we're going to go. We'll say the August highs, we'll call it 43.25. Let's see, percentage calculator, 43.25. We started the year where? Started the year here. Let's say we close at 38.70. Yeah, about 11%. 11% on the S&P will be the target. Pretty average. Again, could we get that kind of 2013 move? Sure. I just don't think it will. I think we'll kind of run out of steam right around 4,300, and then we'll see the next year in 2024. This is a long game, guys. We know the drill. We know what it is. It takes time to get where we need to go, but there's one thing I want you guys to really keep in mind is the thesis. The thesis is lower dollar, lower inflation, and lower yields. That's it. And I think with that being said, you have commodities that have ways to go that are dollar related. We have some names, not extreme high betas, but some growth. And then we want to take a look at ETFs that are going to benefit from this as well, emerging markets. I think emerging markets are going to do well. We saw the DAX and we saw the emerging markets charts. A lot of golden crosses out there with that 50 breaking above the 200 MA. Hell, even the stock market, S&P 500 is getting there. Whew, there's a lot to go over. This was the second time that I did it, so my apologies if I missed anything. I'm going to get this out to you as soon as possible, and I'll type up the report with all the stuff that I said. And we'll have it. You actually have a copy of it. I'll get you the spreadsheet out as well, guys. I'm working on it as we go. I appreciate your patience in all of this. We still have a lot more information to go. We still have earnings to go. We still have the Fed decision. We still have the core PCE to come. Again, this is just what I think and what I see moving forward, and we'll see where we go from there, guys. Have a great rest of your day. Enjoy your weekend, and go Cowboys. I will see you guys on Monday.